Hello and welcome everyone to our weekly crypto journey session. Please post a question down below or even just a comment or your opinion by clicking on the Q&A box just below the screen, and Stephen will try to get to them at the end of his talk. For today's session, we have our very own Dasset CEO, Stephen McCaskill. And without giving too much away for this week's topic, if you joined us last week, we discussed Decentralized Exchange, DEX, and its application. So today is a part two, if you will, or a good extension of what we learned from last week. Stephen will be diving deeper into decentralized finance, DeFi, and explore what yield farming is all about. So let me just hand this over to you, Stephen. Sorry, you're on mute, Stephen.
Sorry about that. Thank you, everyone. Thank you, Merlinda. Really appreciate everyone being here. I'm going to go over a very, very short presentation. I'm trying to get them shorter each time to really focus on the demo and also try and get our lunch sessions down to 45 minutes to get more people to attend to them. And so this is, as Merlinda pointed out, part two of looking at decentralized finance. This is a very specific topic. And so I'm only going into one form of yield farming with one demo, and we'll discuss others at other events. And so I went over last time a decentralized exchange as a just kind of a primer. A decentralized exchange enables people to buy, sell digital assets with the software or smart contracts as the counterparties rather than people or companies like Dasset. And so beginning of last year, there were something like $50 to $100 million in liquidity locked in these applications, these software applications. Now it's $150 billion. And it's a really interesting space that's innovating very quickly. And if you are aware, Uniswap is one of the most popular decentralized exchanges on Ethereum. They've been around since 2017. And they released a digital token on their ecosystem that's a governance token. So you can now buy and own Uniswap token, which is a token used for governing the Uniswap decentralized exchange. Now, they issued this token to people who had transacted on their platform before and people who are providing liquidity on the platform. So the more liquidity you were providing, the more of the token you would have received. Now, it was a one-time event. And so they dropped, they essentially released the digital token, and that was it. And after Uniswap, a number of competitors started popping up. Now, all of this code is open source, so anyone can access it and utilize the code. So basically, somebody just cloned Uniswap, copy-paste the software, and created a copy of it. And there's hundreds of them now. The first one after Uniswap, I believe, is SushiSwap. Now, the problem in decentralized exchanges is liquidity. And so when you are trying to have a decentralized exchange where people can use it to trade one asset from another, there's really a key element that's part of that, and that's liquidity. And large liquidity is usually provided by people with a large amount of capital. So people with a large amount of crypto assets. And so to essentially attract liquidity to the platform, the idea of yield farming emerged. It was initially came out from a lending platform called Compound. And we're not going to go into any lending protocols or lending yield farming today. We're actually going to go into something that's, you know, in the crypto space is considered a lot more controversial, a lot more on the edge, I guess you can say. And so when we look at yield farming, it is created as a way to attract liquidity. And so, you know, there's only so much liquidity in the world. There's only so many dollars, and there's only so much gold in the world. And so that needs to be allocated. And if you have a platform but no liquidity, then nobody's going to use your platform. And so this materialized this concept called yield farming, sometimes also called liquidity mining. The reason why it's called liquidity mining is that you are usually incentivized as an end user to provide liquidity to a protocol with newly minted tokens. So you're mining tokens on that network. And so if you think about a blockchain like Ethereum, you have the protocol, and then you have the unit of account, which is ETH. And the Ethereum network is transitioning from a proof of work to ETH2, which is a proof of stake protocol. And so when you stake the native token, you will be able to receive newly minted tokens because you're helping validate transactions on the Ethereum network. Well, this is not on a main protocol. So this is an application that sits on top of something like Ethereum. And so this application has a native token. For example, the Uniswap application is, the application is Decentralized Exchange, and the native token is Uni or Uniswap. And so the token gives the token holders ability to have say over that protocol. So by holding the token, you might be able to dictate the rates or the fees that traders pay when they exchange one asset to another. You may be able to even decide which assets or liquidity pools get created on the application or protocol. And so you get to essentially, you know, if you think about a traditional business, a public company where you have stocks, and owning the stocks give you the ability to vote in decisions or assign proxy votes to somebody else. It's kind of the same thing. The more stocks you have, the more tokens you have on an application, the more say you have. And so the more involved you have in the outcome of that application. And so this emerged what we know today as yield farming, where hundreds and hundreds of applications started cloning each other and started offering insanely high yields or high rates of return in newly minted coins when you provide liquidity to their platform. Now, 98% of them have failed. I'd consider probably most of them, the 98%, are scams or failures, and they've really taken or rinsed a lot of investors out of their money. Now, why are we talking about this then? I think it's really important to understand this concept so that, one, you know what to look for so you don't get scammed, but also to understand the innovations and potentially think of building blocks on top of this. Now, even though 98% of them have failed, 2% have shown to be extremely innovative, have thrived, and have become billion-dollar projects with tens of billions of dollars in liquidity on their platforms. And so, you know, if you think about a business, 97% of businesses fail in their first 3 years. And so, you know, I guess you can equate it to that, where 98% of these projects fail, but they're failing in the first 3 to 6 months. And then the 2% that are around will be around for a lot longer, and maybe in 3 years, 1% or less of them will be around. So there still is some innovation and interest to look into this. And so so this is where you need to be really wary, because people are looking at this as kind of like the ICO boom in 2017, where it's an easy way to make money off of retail investors. And so if you are a retail investor, there's lots of risk in this space and lots of warning before you look and dive into this. So it's really important to understand your risks, and that's the last slide. I'll touch a little bit on the risks after this, but it's important to also see where the innovation is coming from and where it's going, because it's really accelerated the pace of innovation in DeFi by essentially creating many iterations of the same thing and very quickly. And so some of these iterations have stuck around and are being improved on. And so it's creating something called an anti-fragile system. So in some ways, a lot of these failures are helping the ecosystem identify what's successful and what works. And so failing very fast, failing very frequently, and it's giving us the ability to see what's succeeding and where to go from here. And so, so that's everything on this slide. So some terminology that you need to be aware of, and I'm sure there are a few things that are missed, but total value locked. So that's how much liquidity is in a smart contract. And so if you see a smart contract with $500 million locked in the smart contract, well, that's a lot of crypto, a lot of liquidity. That means it's attracted a lot of people to that platform. If you see something and it has $100,000 in total liquidity or total value locked, it means it doesn't really have a lot of liquidity. It's not really attracting a lot of people. You have to wonder, is this new? Is this something that's been a scam? What's going on here? Annual percentage yield, APY. This is a concept that you'll see on all the yield farming platforms. And basically, it's what is your return? So if you deposit $100 in liquidity, what do you expect to receive in newly minted coins over the next year? And they will range from from 0.5% to thousands of percent. And so if you're providing liquidity for a stable coin, then it's going to be a lot lower. But if you're providing liquidity for a new token, then it's going to be a lot higher, partly because of the it's much higher risk, so much higher reward, and they're also trying to attract that liquidity to their platform. Multiplier, it's basically, there's a concept called essentially farming pools, and they give different multipliers based on where you lock your tokens, and I'll show that in the demo. So LPs, they are liquidity pool tokens, liquidity providers. If you saw the last demo, we went into how to create an LP token, how to provide liquidity. So I'm not really going to go into too much detail there, but degen. So this is something that comes up a lot, and it's brought about this meme culture, and it's not necessarily the most positive thing. If you think about things like Wall Street bets, and it's very much that culture that has come to DeFi. Or maybe it's vice versa. Maybe what's happening in yield farming has gone to Wall Street bets. But really, it's a concept that if you're yield farming, you're being a degenerate essentially, and that's a degenerate ape. and because you might hear some concepts like you're aping into an asset. So you're buying an asset early on, and it's essentially you're doing something that's extremely risky, extremely high risk, and so you might have high reward or you might lose it all. And so that's kind of where this idea comes from, or where they call them degens. And so the risk and permanent loss, I went into that risk last time, and I'll touch a little bit more on this today, but the big risks are rug pulls. So a rug pull is, and so this is something to keep in mind, is how people are using yield farming to essentially take money from retail investors. And so what they'll do is they'll create a token that has almost no new innovation. They'll just copy paste a token, they'll copy paste software, a website, and release the token, promising really high yield returns with newly minted tokens. Now they've created the first tokens, and they'll be selling it to you, who provides liquidity because to provide liquidity, you have to buy their token. So you buy their token, you provide liquidity. So you provide USD or something like Ethereum or a well-known token alongside that token. So you provide liquidity to this token. Now the creators of the token will then take their tokens and sell them to you. So they'll buy all the valuable assets that you've provided in liquidity, the Ethereum, the USD, or the BNB, whatever that token is, and they'll walk away from the project with the good money, and they'll leave you with these digital tokens that have almost no value. And so that's something that comes up sometimes. They're called rug pulls, and a lot of them have occurred. Now, the other risk is hacks, frauds, which sometimes you can't tell the difference. Sometimes there might be a hack, and people will blame the creators of the project. But it really comes down to poorly implemented smart contracts that enable exploitations of the smart contracts to funnel the funds that have been provided in liquidity. And that's something that is something you want to keep an eye on as well. And so how do you mitigate against those things? There are a few different metrics you can look at. The one is looking at the team. So is the team public, or are they anonymous? If they're anonymous, it's higher risk. If they're public, they have a reputation, they've been in the space for 10 or more years, then it's a lot lower risk because it's a lot easier to find them somewhere in the world and go after them. Looking at the actual smart contract. So has the smart contract been audited? Has it been reviewed by third parties, by independent third parties? What are developers saying about it? It's not necessarily the case that anybody can just hire, anybody can hire a developer and walk them through the code, but you have to find a developer you trust. They have to understand smart contracts. And so, there is some technical barrier to entry. And so, it's really important to do technical due diligence, especially on a brand new project. Then after that, if you're unable to do the technical due diligence, then looking at how long the project has been around. So a project like Uniswap, Decentralized Exchange, that's been around for 4+ years, that has now distributed their governance token in such a way that's a lot more decentralized than some other projects. There's a lot lower risk with a platform like Uniswap. But so it really comes into different factors that change this risk dynamic. So I'm going to switch to a demo now. And before I do that, are there any questions?
None so far, but just a reminder, I can see that a lot of you have been asking about the previous webinars. They will be available a month from the date in our YouTube channel. So again, a reminder, please drop a message, a comment, or a chat in our Q&A box, and Stephen will get to you at the end of this.
Okay, so we have Binance or BSC scan. This is a kind of like a Google for blockchain. It's called a blockchain explorer. So you can look at every transaction that's happened on Binance Smart Chain since the beginning of time. Now, Binance Smart Chain's a new blockchain, and I don't endorse it. This is just purely for demonstration purposes. And so it's a fairly new chain that kind of enabled people to have really fast transaction speeds, high transaction throughput with low fees. And it's a great platform to experiment with, but it comes at trade-offs. It's very centralized, and Binance, the company, has a lot of control over it. So they do have the ability to lock your funds. It would require a lot of effort. It would have to be a really important reason, but they do, as the gatekeepers, they do have the ability to censor transactions on this network, or essentially prevent you from pulling assets in or out of the network. And so, it's a little bit more centralized, but it also kind of enables us to see a little bit ahead in the future with what blockchains can be. So if you go here, you'll see a list of yield farms. And what we're going to do is kind of go back in time. We'll see the very first one. So Binance Smart Chain came out about a year ago. And so very new. And as soon as it started coming out, these decentralized exchanges and services started popping up. And each one of these is a yield farm. And their purpose was to attract liquidity to their platform. Now, as you can see, it started kind of being a race to launch these, because since then, over 200 decentralized exchanges or similar types of products have been released that all offer yield farming. So all of these are yield farming platforms. You can look at the dates, they're very close to each other, and you'll also start looking at the names. The names start copying each other. So there's a lot of overlap. There's a lot of iteration in the innovation. And for example, all of a sudden people started using food as names of these decentralized exchanges, and then they started calling them animals, and so you'll find all kinds of different things here. So all of these are decentralized exchanges. All of them are have provided liquidity farming or yield farming in the past. Now, 98% of them are essentially, I wouldn't necessarily scams, but are have either lost 99% of their value, or the project owners have walked away from them. They haven't innovated on them. And you can see here, some of them, they'll even say, these guys had a rug pull. So that means that they walked away from them. These guys say these are questionable. You always want to do your own due diligence. So let's look at these. So this is kind of just going down the list of history. And so Burger Swap was one of the first you'll see. So Burger Swap. So it was the fourth protocol, and here it's still going. And if you've looked at things like Uniswap, they all kind of look the same. So you can exchange one asset to another asset, and then you can provide liquidity, and then you can start yield farming. So I'll show the yield farming part in a few. This one's Peach Swap, so it's named after a fruit. Bakery Swap. This one's really popular. This one hasn't gone anywhere. And the reason why is they implemented an NFT marketplace early on. And so they're one of the only, or one of the first NFT decentralized exchanges. And so, not only can you provide liquidity, you can exchange tokens, you can also buy and trade NFTs on their platform. And I'm just going through, again, I haven't vetted any of these. I'm just showing you that, a lot of them look very similar. You'll see almost no innovation on them. And so here's, this one's called Kebab Finance. And you'll see here, so it has total liquidity. I thought it's, yeah, so $500,000. So not much liquidity in this platform. So it's something you might not want to touch. Faux swap is something I saw, but as you can see, the website doesn't even work. So stay away from that one. This one, you'll see, has a very similar look to another one we'll touch on in a few. You can see this one has $11 million locked. And so it has a little bit more liquidity on this platform. It's not dead. They're still trying to innovate. I found this one, Kiwi Swap. I don't think it's managed by a New Zealander or Kiwi, or it has anything to do with New Zealand, but it is something that I found as one of the yield farming things out there. Cougar Swap, that sounds more like some kind of dating website or something. So a lot of these have really terrible names. And you can see a lot of them are very similar. So we'll go to Pancake Swap. And this is the one I wanted to show you. So this one's interesting in that it's has billions of dollars staked in the platform. So I'd say in terms of Binance Smart Chain, that Pancake Swap is really the kind of like Uniswap. I wouldn't say is official. It's kind of Uniswap's been the go-to or the standard DEX on Ethereum or on the Ethereum network. And so on the Binance Smart Chain network, Pancake Swap is that go-to. It's that standardized one. It's the one that everyone recognizes, which is why it has, $11 billion staked. It's had in the last 30 days, 45 million trades. And 2.6 million, I don't know if it's users, but addresses that have interacted with them. And so this is an example of one, and you can see they're actually launched very early on. So, they were one of the first, 10, 15 projects to launch. And part of that, I think, is also part of it. They were the first, they established the liquidity the first. They essentially established themselves as a reputable entity before everyone else. I'm not going to go into it too much, but there's a lot of innovation on the back end with the smart contracts. So the way the smart contracts are managed, and so some of these are still around because of the innovations in the technology on the back end that have made it safer for the end users. And so last time we did a little demo here. I'm going to do a quick demo here. I'm just going to trade one asset for another. So I'm trading this token Rune for BNB, which is Binance coin. Now, for me to do this on a decentralized exchange, I have to somebody has to have provided liquidity. So I'm using somebody's liquidity to make this exchange. And so I'm just getting some BNB so I can provide liquidity. I've already done this part of the demo last time, but just going through it again. Using MetaMask, I have my hardware wallets connected with MetaMask so that my private key isn't kept on my laptop. So I definitely recommend using hardware wallets. So I'm just signing this transaction. So I just made a trade on a decentralized exchange on Pancake Swap, one of the most reputable, and also going to buy their native token. So they have a native token called Cake. We'll buy some cake. So that's the other deterrent sometimes. These names are absurd. Things like Alpaca Finance or Pancake Swap or Bakery Swap or Kiwi Swap. They don't sound professional. They have this very degenerate vibe, I guess you can say. And so it's, but some of these projects have attracted billions of dollars in liquidity. And the people who are providing liquidity are crypto natives. So they are people who've been around in the crypto industry for many, many years. And they're looking at the technical smart contracts underneath to identify whether these are viable products, whether they're viable technology. And because essentially they have these crypto assets and they're not doing anything. And so this is a way to put your crypto assets to work. And so I'm providing liquidity for Cake and BNB. And so I'm providing one BNB. BNB is, I don't know what the price is, somewhere in the range of 450 to 550 US dollars. And so let me actually go back to that. So I'm providing liquidity, I'm supplying. So to provide liquidity, I need both assets. So I need BNB and I need Cake. And so when I confirm, it'll show me what I receive. So I'm essentially, when it loads, oh, sorry, I just need to cancel this transaction first. Okay, just rejecting this transaction. So you can see what I was, okay. So basically, I'm providing one BNB and 20.2 Cake. And so you can kind of see what the prices are between the two. I'm receiving this. So I'm receiving 4.395 or 4.396 LP tokens, so liquidity pool tokens. So I'm receiving a token that is essentially a receipt or representation of my liquidity. And so I use this digital token to redeem my BNB or my Cake tokens. And so you can see my share of the pool. So of I'm essentially putting $1,000, 1,000 US dollars in liquidity, and my percentage is extremely small, so 0.0001. So there's a lot of liquidity in this pool already. So by providing this liquidity, I receive a fee every time somebody trades. So I receive 0.1% every time somebody trades, but it's that 0.01% is distributed to all the liquidity providers. So I only get this percentage of that. And so I don't really get that much. Maybe if I'm providing, $100 million in liquidity and over a long period of time that I'll receive some income from the people trading that. But what I'm doing now is confirming that I'm providing liquidity so that when somebody else comes along and they want to buy Cake and they have BNB, they can buy it and they'll buy some of that Cake from me and I receive more BNB. So this is me providing liquidity, but I haven't started yield farming yet. So although I receive the fees from the people swapping or exchanging, I don't receive any income from yield farming. And to do that, I have to go over here. And so the second element of yield farming is that what they're trying to do is encourage people to lock away the supply of their native token and lock liquidity for a long period of time. So they're trying to create certainty. So if you are providing, so you can lock, so sometimes they have, so now I have these LP tokens, and what I have to do is stake the LP tokens into a pool. And so I have to stake it into another smart contract. And what that means is that I cannot redeem those LP tokens for liquidity anymore. I can essentially lock that liquidity. And some people require incentives for me to lock liquidity for a week, 3 months, 3 years. So if I might have to put this liquidity away for 3 years to receive a certain rate of return. And that means that I have guaranteed, I've given them a lot more certainty, the project a lot more certainty by guaranteeing or committing a certain amount of liquidity for a certain amount of time. And in return, I get newly minted tokens. So the Cake token supply is still increasing. So if you think about Bitcoin, Bitcoin's released by proof of work. When you validate a transaction, you get newly minted Bitcoin. Same thing with Ethereum. But with these tokens, you receive newly minted Cake, for example, or newly minted tokens by providing liquidity to the network and locking that liquidity. So they set this arbitrary multiplier. So they get to set the multiplier, and basically the higher the multiplier, the higher or the more tokens you receive from the distribution of newly minted tokens. So Cake is the native token, and they are looking for the most liquidity to their native token, so they have the highest multiplier. So with a higher multiplier, you get a higher return. So by providing this liquidity to Cake, you get newly minted Cake tokens. And so I provided some liquidity earlier. So you can see of the last 2 hours, I made about 4 cents in liquidity from providing this, by providing liquidity to this yield farm. So I have my LP tokens. I'm going to add some more. So you saw I received these LP tokens from providing liquidity. I'm now locking these LP tokens away. So I'm locking it into the smart contract. So I can no longer redeem my Cake and BNB. I have to essentially unstake it from this smart contract to gain access to my BNB and my Cake again. So I'm essentially committing liquidity as available for them to use, or for the protocol to use for a longer period of time. So now you can see I've my stake has increased in this pool of staking about $2,000. Now, if I was staking something like BNB and BUSD, it's a lot lower risk. So I'm staking digital US dollars and Binance coin. But the problem, the risk by providing this liquidity is if Binance coin goes up. So if Binance coin goes up and people buy it from me and I unstake, then I have a lot more USD and a lot less Binance coin. So part of the offset in this yield is the offset and impermanent loss from the value of the token going up in the future. And that's where it's a little bit of a risk, where by providing liquidity in another token, you might receive lower returns than if you were just holding the native token. And so there's a little bit of a trade-off. And this is where I want to show you a couple more tools. So there are these aggregators that essentially take a large amount of liquidity and they put them into different liquidity pools for you. And so they manage the movement of your funds from one liquidity pool to another and to try and maximize returns. So this is one, it's called Beefy Finance. They have $500 million in liquidity locked. And so when you lock in their token, or if you lock into one of these farms, you are essentially putting it into a number of different liquidity pools, and they manage it for you. And so you can do this boost. What this will do is you essentially lock it for a certain amount of time. So that means that they have a bit more certainty with the liquidity, and you have a little bit higher yield. So you can kind of see what the rates are here. And so Yearn Finance is another one. They essentially aggregate your liquidity into the highest returns. So if you're thinking in terms of dollars, US dollars, then you might be interested in something like this, or New Zealand dollars. But if you're thinking in terms of crypto, you can put your dollars into something like Ethereum, or you can put it into something like a yield farm or yield farm aggregator. Then it becomes a little bit more uncertain, where you might have better returns just holding Ethereum. You might have better returns or returns holding the or providing liquidity. I think that there's a little bit of strategy that needs to be done to work it out, but there are tools that help you with that. So somebody asked about the tools. This is one, DeFi Yield. This is an Ethereum-based tool where you can connect your wallet and you can essentially watch your yield performance. And then they also do certain services, like I believe they do they review things, they have audits, they essentially go into different projects and they'll do some reviews for them. So they also have this thing called an impermanent loss calculator. So you can identify what, you can essentially I figure out what the impermanent loss is based on the change of that asset price. So if the asset price goes up a lot, you can, if you think an asset is going to go up by 100%, you can figure out what the impermanent loss is and identify whether you can have higher yield providing liquidity or just holding the token. Here's another one. This one's for Binance Smart Chain. Somebody was asking about it. This is one that I connected my wallet to. And so I wanted to go to the home page, but let's see here. Okay, yep, so this is the home page. When I go and look at it, I can look at my portfolio. It's just looking at my wallet, and it's looking at what I'm providing liquidity to, and it gives me some details. And so, for example, it tells me so here we can see the pool that I provided liquidity to. So it tells me what my annual percentage return is, 34%. So I'm currently getting 34% providing these $2,000 in liquidity, but the $2,000 is in Cake and BNB. And so, the value of Cake and BNB, who knows what it's going to be in a month or a year from now. It could be higher, it could be lower. If it's higher, then not only do I get, higher value in terms of asset appreciation, but I also get a 34% return. And so there's potential huge benefits by providing liquidity here. But at the same time, there's opportunity costs. What else can I be doing with this capital, or just holding it could be a safer option. But if you look at this, you can see there's nearly $1 billion in liquidity locked in this one liquidity pool. And so that's quite substantial. And part of the reason why is PancakeSwap, I wouldn't say it is endorsed by Binance, but there's a lot of overlap, I think, between Binance and PancakeSwap. And so I don't know if it's officially endorsed by Binance, but I think, you know, Binance would be happy to talk about PancakeSwap. So a lot of people who are providing liquidity for Binance may also be providing liquidity on PancakeSwap. And so you can see, oh, I need to buy some of their token. So they have this pro version, and to get the pro version, you have to buy some of their token. So let's see here, watch. I'm just gonna, so this is another interesting concept, how to provide services. So I have my wallet connected. I have my wallet connected to YieldWatch, and for me to use their professional services, they want me to purchase a certain amount of their tokens. So I'm buying a certain amount of their tokens. So, and it's because I'm connected to their website through my address, they know exactly how many tokens I have. And so if we go back, it'll unlock their pro features, and that will give me access to a lot more functionality on their platform. So I'm just going to refresh this. Should now have access to their professional services. Now, and then lastly, there's for people who don't care about the, so now you can see, you can kind of see my, a breakdown of my portfolio. If I had a lot more yield farming, then you could see, you know, all the pools that I'm in. You'd be able to see them all here. You'd be able to see a lot more detail, so you can see how much I deposited, and you can see how much I currently have from impermanent loss. You can see, so it gives you a lot more information here. You can see, you know, how much I've deposited, how much I've withdrawn. You can see so I've made, since depositing 8 LP tokens of the last 2 hours, I've already made 0.001 cake. So I made about a cent in income. So after, you know, so you can kind of track it in real time. I've made 1 cent from providing this liquidity, and I'm making currently about $1.89 a day by providing this liquidity. So there's definitely some tools out there. And the last one is, if you don't like, you know, the websites, all the views, that kind of stuff, this website aggregates all the yield farms on the different networks, so you can see it does the exact same thing. I'm interacting with PancakeSwap's pool, but you can interact with these are all different yield farms. And so you can just interact directly with them. PancakeSwap's the one at the top. So when I click here, it's basically doing the same thing as everything I did here, but without the shiny graphics. And so it's connecting to my wallet. It's showing the staking contracts. It's loading them, so that'll take a little bit. But then I can provide liquidity directly from this page. And so people will use these tools as opposed to going to each website, because it's a lot easier to aggregate and manage from one site. And as you can see, they've really simplified it. But I'll stop there. So yes, you can see, you know, I can stake into a pool right here without having to go through, so I can stake more I can do everything I need to do from this page. But I'll stop there and open it to questions. So questions.
Thank you, Stephen. We have a few questions to go through. Do you believe the more people know about yield farming or yield farming strategy, the less effective it may become?
Yeah. So I think in some ways it'll help get rid of, well, it'll help attempt to get rid of scammers because people are looking for a lot more legitimacy potentially. I think there's still going to be a wave of scammers, could potentially get worse before it gets better. But, as more people provide liquidity, the returns will drop. Absolutely. And, as these platforms legitimize themselves, the yields will drop. Like Cake's yields are a lot lower than what they were 8 months ago. And in a year from now, it might only be 6%. So this APR that you see here could be a lot lower, but still pretty high because they're attempting to attract a limited amount of liquidity that exists. And they're trying to attract it from places like Uniswap. And so, so the more liquidity they attract from the big players, the more the lower the yield, the lower the returns, but also the lower the risk. And so there's trade-offs. And this is looking at the innovation. Who knows what can materialize out of this? If you look at something and look at it as kind of a penny stock, there might be some new emergent technologies that emerge out of this that enable that are kind of like a new wave. And so that's high risk, high return. And so we'll see. I don't know, it's evolving.
Yeah, it's really important for them to do their own due diligence as well. Next question, can you only use, sorry, give me a second. Are you only able to deposit or use stable coins?
No, so the one I provided is a good example where the token, the counterparty token, if you will, is BNB. So BNB is I don't know, in the top 5 digital assets, it's finance coin. And so I guess it depends on what your definition of stablecoin is. So if you're providing liquidity like Ethereum, Bitcoin, BNB, then that could essentially be considered the stablecoin of that pool. It's the token that people understand and trust. And so you can provide cryptocurrency like Ethereum, so it doesn't have to be a stable coin. Now, if you're just providing stable coins, the yield is a lot lower. It tends to be a lot lower. And so it really depends. So if you're providing something like a stable coin against another stable coin, then the yield may only be 0.5% or lower. And so it really depends. And so, if you're providing Cake and BNB and you think they're both going to go up, then this might be better than Cake and BUSD.
How about ERC20?
Yep. So tokens like this, like Cake, so they are BEP20s. So they are essentially ERC20s on Binance Smart Chain. And so on Ethereum, you would be able to provide similar tokens for liquidity on different platforms, but it wouldn't be like one ERC20 against another ERC20. So you'd be providing an ERC20 on one side of the pool, and you'd be providing ETH or stablecoin on the other side of the pool. And so, you are low risk on the BUSD side. You also don't get any gains from that, BUSD or stablecoin going up in value.
And last question, is staking and providing liquidity the same?
So they're similar, but different. So staking is, I'd say, too generic as a term. If you, if you look at that kind of process, we have, so you can stake a native token on a blockchain. And what you're doing is you're providing a valuable service by essentially you usually need to set up a computer and you validate those transactions. And so so it's like staking Ethereum 2.0 and you're receiving newly minted ETH. And that is very, very different from how you're staking on essentially an application. And so you're staking into a smart contract. So you are staking and you are locking those tokens in a smart contract, but it's a very different concept. So you're not helping support the infrastructure. You're helping support providing liquidity, which is a little bit more abstract. And you are receiving newly minted tokens, and so in that regards, it's the same. But the way that the newly minted tokens are distributed is very different, very, very different from how something like Ethereum's distributed. And so, you are staking, but I'd say it's you get really start getting confused when you say, oh, it's staking. And there's different types of staking. So I'd say this is I'd stick to calling it yield farming.
I see. Good. Thank you so much for that, Stephen. Well, that's all we have for you today. Thank you for everyone for joining us on your lunch break to talk about Crypto Journey. We do appreciate you tuning in and hope you learn a little bit more about crypto and staking and yield farming. If you're interested in any topic you'd like for us to cover in one of these lunch sessions, please let us know. Drop us a tweet at DassetX, a message, or even an email to our awesome Dasset team at support@dassetx.com, and would love to hear from you. Before we sign off, I'd like to remind everyone that this crypto journey is held every Thursday around 12:30 p.m. So don't forget to tune in for next week. Any last words, Stephen?
I really appreciate everyone attending. It looks like the number of participants is increasing quite a bit each week. And yeah, it's really exciting to share these topics with you. And hopefully you guys are getting a little bit more hands-on. We definitely want to make sure that that you're getting the most out of your crypto journey. So thank you so much for being here.
See you next week.